Good morning and welcome to the Friday Financial Review. I'm Paul Griffiths. I'm a financial planner for Europe. So last week I did a piece on lowering the effective rate of tax for pensions, on pensions for those resident in Spain. As a result, I had a few requests from clients as well as my followers who live in France to do a similar piece on whether there is something that can lower the rate of tax as a resident of France when it comes to your pensions. So today we are just going to do a piece surrounding that. So within France, like most other European countries, they have their tax regime when it comes to pensions. And like many European countries, what you tend to find is that for those who come to France and have their own accumulated pension from their country where they worked before or their home country, then potentially there are interesting rules within France that one can utilize to your advantage. So we are purely going to talk on the assumption that you have an accumulated pension or pensions within the UK and what one might consider when you are now in France. Okay. So as you know, to be able to access your UK pension first and foremost, you have to be age 55, although that is increasing to 57 from 2028. You should also be aware that the UK introduced its pension freedom rules several years ago. This in essence allows you, the pension member, to fully access your pension pot if you wanted to. So this certainly applies to defined contribution schemes and private pension schemes. If you have a final salary scheme, defined benefit, you can't take your pension pot in one go in its current form. You would have to transfer those benefits out in the form of a cash equivalent transfer value, but you do give up those very important guaranteed income, of course. Now, in France, there are a couple of different pension taxation rules. We are going to concentrate on what we call the flat rate lump sum tax. Okay. So when we say lump sum, many of you will automatically think of the 25% lump sum that you can take, which would be free of UK taxes, but of course very much taxable in France, or if you lived elsewhere, the likelihood is it's taxable as well. In France, they do not consider any form of percentage as a pension lump sum. So you can, in actual fact, take out an amount of pension in one go and declare that under the French regime as their lump sum. Now, why would you want to do this? Simply put, in France, the pension lump sum tax is only 7.5%. So let me repeat, 7.5%. So if you can imagine, if you have a pension pot of £200,000, you could in actual fact take it all out in one go and pay only 7.5% tax in France. Of course, it's not always as straightforward as taking it in one go. There are steps to go through as to ensure that the UK pension provider themselves do not withhold unnecessary tax. And of course, that's usually what happens. The UK pension provider goes by or is guided by only your HMRC tax code. So if you did take out 200 grand, The first 25, of course, they wouldn't withhold any tax, but the remaining £150,000, the 75%, they would indeed withhold taxes, pay it to HMRC, and then of course it's your job to submit the relevant forms to HMRC to reclaim that tax back. You will be able to reclaim that tax back because in France, if you have a private pension, France has full taxation rights. So you will be able to claim it back. Or if you do speak to an advisor and with the right pension plan, you could take steps to avoid that situation by obtaining a nil tax code. So that's an NT tax code from HMRC. To get one of those is a separate conversation. So back to the 7.5. Your 200,000, let's say you were able to extract the whole thing with no taxes deducted by the pension provider in the UK. You then declare that here in France, pay your 7.5% tax, and your money's taxed, and now it is your capital for reinvestment, do something else with it, entirely up to you, of course. Okay? Of course, one also needs to be aware that within France, there is something called the pension social charge, currently at 8.3%. So you would be liable to pay the 8.3% charge on top of your 7.5%. So do be wary of that, taking the overall tax to just under 16%. However, you are able to potentially avoid being liable for the 8.5% pension social charge. And you can avoid this on one of two things. If you're in France and register for your residency and you're not of state pension age yet, you might have registered under a private healthcare insurance system. Thus, you are not a burden on the French healthcare system. If that is the case, and you're able to prove it properly, then yes, you would be able to avoid having to pay the 8.3% on the lump sum that you've just taken from your UK pension. Conversely, many clients, they have various pension pots. They don't always take all their pensions in one go. Certainly the clients that I speak to, they get to a certain point, you're now age 66, full receipt of the UK state pension, and you've applied for your S1 and been granted the S1. Well, the S1 is an agreement and it exempts you from having to contribute to the French healthcare system. Simply put then, if you're under the guise of the S1, it would mean that you wouldn't be liable for the pension social charge on that lump sum that you've just taken. Of course, right now, I believe from my accountant certainly that the S1 in the UK is slightly up in the air at the moment. There could be changes due to Brexit, but certainly for the time being, this is how it stands. I say all these things to you today. It is a very advantageous tool to use in France. If you do have several pensions, you can consolidate it. If its total is 100 grand, 200 grand, $1 million, it's irrelevant. You can just take it all in one go and pay the 7.5% tax, and off you go. I would say it's not for everybody, purely because a pension itself, the vehicle itself, is actually quite advantageous from an inheritance and succession tax planning standpoint. But if you feel perhaps the advantages outweigh those things, then certainly doing the lump sum tax works. But of course, you don't have to take your pension in one go. Remember what I said, the French do not recognize whether it's a 25% lump sum, 50% lump sum, 100% lump sum. Yeah, if you've got a £500,000 pension pot, you like the idea that the pension vehicle itself serves a really good purpose for inheritance, you may decide, I tell you what, we only take out 50% of our pension pot, leave the other 50, have that 50 declared as a lump sum, pay the low tax, off you go, reinvest it in something else, okay? The last thing I just want to say around this lump sum issue, of course, is that whilst it's very, very advantageous, the 7.5%, you can only ever use it once. I think in the past there have been various instances where accountants and clients have been declaring their income here, this year, that year, this year, that year as lump sums. But I do believe there was a court case back in 2018 and judge ruled that, look, you can only use it once. Anything after that is simply deemed as normal pension income. Okay? So that's it for this morning and today's Friday financial review. Next week, we will embark on Portugal, and then I'm going to expand my horizons onto Cyprus. I just want to thank you all for subscribing, following, and sharing my videos. Do continue to share them, please, and thank you very much for your support. I wish you all a very, very wonderful Friday, whatever you are doing. Have a lovely, lovely weekend, and I'll see you all again next week. Bye for now.